Here's what the best thing that happened to me all day. So I went out for a run this morning. I came back and my wife said, "Hey, Greg, you need to listen to this." And so I saw my daughter kind of like walk by. She did this like little look. My daughter's 7, about to be 8. And she did this little look like she had something special for me. But she walked away because she had already coached my wife on how to deliver this. And she said, my wife said, you need to listen to this. So my daughter had recorded, and I wish I could play it for you. I can't play it for you right now. My daughter had recorded. See, we've been talking a lot about, how you're controlling your emotions and how your attitude is within your control. And just because you have a bad thing that happens to you doesn't mean you have to have a bad day. And it's important to speak with kindness and all this good stuff. So late last night, as my wife was putting my daughter to bed, she was laying down with her. My daughter had recorded her game plan. She calls it her ladder for controlling her emotions and for having a positive attitude. And so she went through this with me and she said, my first step is I'm going to go pout for 1 minute if I'm upset about something. I'm going to go pout. But my next step is I'm going to say to myself, I'm Isabella Rose Cohen and I don't need to be upset. I'm a positive person and I don't need to have a bad day. And then she went through the next 3, 4, 5 steps in the ladder for her to turn it around. And so that was the best thing that happened to me all day. She did this. And as my wife was sharing this with me, my daughter ran in, gave me a huge hug, and it was the best start to the day. So
that's incredible, man.
It was awesome.
How old is Bella?
She's going to be 8 in about a month now.
Man, 8 years old already putting in positive mindset stuff to hold her in. Well,
that's what it's all about, brother.
That's pretty incredible, man. She must have some pretty good role models. Anyways, we are live on Facebook, by the way, Greg. You were wondering where my excitement was for the live on Facebook thing, and we are there. Thank you for sharing an awesome story about your daughter's system for positivity. I think it's really, really cool. And today is our typical Thursday show that is Q&A driven for people that are just joining us for the first time. My name is Pablo Gonzalez. I'm the co-host. Gregg Cohen, my amazing co-host as well. Say hello, Greg.
Hey, everybody.
And today, like I said, it's a Q&A format, right? So a couple of housekeeping tools for the newbies, and we love having you. We also love having our regulars, right? I'm seeing a lot of names here that are starting to pop up time and time again. Medj Garcia is officially a regular now. Mike Foster, Marilyn Cotterman, Lonnie Thompson. We've seen you a couple of times too. Lee Bishop. Jim Kirko had awesome questions last week. I remember him, because we cut some of his questions out and made it into micro content for social media. But I digress. If you want to chat with us, hit the chat button, drop the drop-down blue panel that says all panelists, and change that to all panelists and attendees so that everybody can talk with everyone else. And if you want to ask a question that I'll ask on the show to Greg, pop open that Q&A dialog box and put your question in there. We keep track of all of that, and we get back to you if we don't get to it on the show, which tends to happen from time to time. So I want to make sure that you're putting it in the right place. And as always, if you are new and you want some fundamental advice on rental property investing and want to know exactly what it's all about, go to jwbwebclass.com. It's a free class that Greg teaches that will teach you everything that you need to know, from what the best markets are, how to find them, what to look for, how JWB does it, who, by the way, is the best in the game. And if you want to hop on a call with our team, go to chatwithjwb.com, schedule a call with one of the mics who will talk you through anything that is particular to you, value add. And without further ado, let's get this thing rolling. Greg, what's going on, man?
Yeah, brother. I want to give some shout outs to some of these awesome things that have been happening in the lives of our folks here.
Let's do it.
You guys have something awesome you want to share. This is all about positivity. So Ashley's on my team, and today is her 2nd anniversary at JWB. She is crushing it. She said she walked into the office to so much love and some anniversary goodies, and she is quite a teammate. We are lucky to have her. And she's also Lee Bishop, who is a regular here. Hello to Lee. Always good to see you, buddy. Ashley is Lee Bishop's portfolio manager. So she is the person most directly responsible for Lee's success here in his investment. And so he said, way to go, Ashley. So always good to have some some connections here between our team and our clients and the group. And man, everybody's saying hello here. We're just feeling the sense of community and engagement. I appreciate you guys being here, man. So I'm good.
Yeah, it's awesome, man. I love it too. And speaking of connections, one of our regulars that just showed up on Zoom is Everett Shapiro, who also is connected. He was the father-in-law of this week's guest, Rich Ritchie, which talked to us about mortgage rates and the opportunity that's out there right now. And in that conversation, we had, overall, there was a discussion about how Rich was private lending and he's building his rental income portfolio and how to consider each of those. Gregg, do you want to give us a little bit of scope onto when to think about private lending versus when to invest in turnkey rental income properties?
Yeah, absolutely. So it's a really common question. JWB really offers two investments out there. There's the turnkey rental property investment, which is where you actually own the asset. You buy the rental property. JWB has done everything for you and continues to do the property management for you. So it's a passive investment for you, but you actually own the house. The other investment is private lending. Private lending is different, right? In private lending, and Pablo, you're a private lender, right? It's like you are the bank, right? You are lending on a project that JWB is doing. That project very well and most likely will turn into a turnkey rental property that will then be purchased by another client. But for you in that setting, you are simply the lender on that property. So a common question is, which is better, right? And what do you think my answer is, Pablo?
Depends on what you're trying to do.
Yes. Yes is the answer. They're both good, but Pablo's right? It depends on your goals. So I was kind of laying out which is better for a certain investor and which may be better for another investor. So, in owning the asset, what you get is all the benefits of actually owning an asset, right? So you get the positive cash flow, right? You get the tax savings, you get principal pay down when your tenant is paying your loan down for you, right? You get the benefits of holding a hard asset as inflation occurs over time. So that makes it easier for you to pay off your debt over time just simply by devaluing the debt. And then the big thing is property appreciation, right? By owning the asset, as the asset goes up in value, you are the beneficiary of that, right? And as we talk about, the reasons why a lot of clients come to Jacksonville to invest is because you get positive cash flow, but you're also in a growth market and you plan to hold on for a long time. And that positive appreciation really, really becomes a driving factor in your overall return on your investment. Now, the way to supercharge your returns when you own a turnkey rental property is by using financing. Because what many investors doesn't really compute in the beginning is that as your appreciation goes up 4% per year, which is the historical average in Jacksonville since 1991, on average it goes up 4.3% per year. That doesn't just mean that you're getting 4% of additional return on investment if you're using financing, right? If you're putting 25% down and the asset value goes up 4%, you're actually earning a 16% return on your money. All right. So now as we're talking about what's better, private lending or owning the turnkey rental property, in the turnkey rental property, you get all of those profit centers. All right. And so your return on investment is actually, including the appreciation, much higher than what your return would be for private lending. Right. If I was being super aggressive with my calculations and I was assuming property appreciation in them, which I don't typically do, but you're over 20% returns if you're counting all of that based on historically accurate assumptions. So that's what you get. You get better returns if you actually own the asset, most likely, right? Now, if you go to private lending, what are you getting? Well, in private lending, it is so much set it and forget it, right? What you don't get is you don't get the growth of the asset. So on the house that you're lending on, if it goes up in value, you don't get to enjoy that, right? You're just the lender. Just like right now for the house that you own, that you live in, the bank doesn't get the appreciation you do, right? The bank lends to you, you get the appreciation. Well, it's the same in private lending. But what you do get is you don't have to worry about maintenance costs or vacancy costs, right? Now, for turnkey rental properties at JWB, that's what we hang our hat on, is minimizing that. And we're really good at it. But at the end of the day, we'll share with you that it's a part of owning rental properties. There are going to be some months where you have a vacancy if you hold on to it for some amount of time. If you're a private lender, you never have to worry about that. So it is so much set it and forget it. Consistency, you can't get more consistent than private lending. The barrier to entry is a little bit lower. You can get into private lending for as little as $10,000 to invest. You need more than that if you're going to own turnkey rental properties. $40,000 at a minimum is what you'd need for turnkey rental properties. So, turnkey rental properties generally, if folks are looking to acquire the best return on investment while also mitigating risks, owning the asset is usually where they'll go, especially if they're using financing, right? You get a much higher return there. Folks that are nearing retirement may go more towards the private lending route, or if they already have enough rental properties in their portfolio and they kind of check that box, they may go to the private lending route. If they're trying to eliminate debt in their life because they're nearing retirement and it makes them sleep better at night and they don't have alternative sources of income, they may go more towards private lending. But more often than not, clients do both. Both of these are great assets. They're a way to diversify within real estate, right? We talk about how diversification is important. You don't have to just do one thing in real estate and then go to the stock market. You can diversify within real estate. And that's how I personally use it. I have both private lending and turnkey rental properties in my portfolio. So hopefully that helps.
Makes a lot of sense. John Evans has a clarifying question here that asks, how about lending on property you will buy when completed? Which reminds me that you guys roll over the private lending into rental income properties if you want to, right?
Yes, two separate things though. I think what John, and it was John Evans that asked the question, right? Yep. All right. I think what John is asking is, could he be the private lender that would then turn into the owner of the rental property? It's never happened in the thousands of properties that we've sold. It's never happened. I don't know if it wouldn't happen just because of the logistics of it. I don't know. I don't see any reason why it couldn't technically happen, but it just doesn't happen that way. The chances of that happening, I mean, you're going to be doing the private loan. Many times we're going to be building a new construction house. So you'd be lending on it and call it 6 to 9 months later, the house is built. And then, the chances of that property lining up for you to be able to purchase that in your portfolio, for it to be the right investment for you is, I don't know. It's a whole lot of variables there. So I guess in theory it could happen, but it's never happened. So it's just not really necessary to do. You can accomplish both and it just doesn't have to happen that way. Now, what you were speaking of, Pablo, was how easy it is to convert as a private lender into actually owning a turnkey rental property. And so with private lending, you have a 3-year term, meaning your money's going to be locked up for 3 years. And many times we pay that off early, but that's what you need to be prepared for. So we talk a lot about how private lending is a great stepping stone for those who are thinking about getting into owning a turnkey rental property, but they don't have the capital yet, or it's just not the right time yet. And so they might invest $10,000 in private lending. Well, what happens if 6 months or a year down the road, they get a big bonus at work? They get a $30,000 bonus at work and they want to turn that into their first turnkey rental property. Do they have to wait until that 3-year term is over? The answer is no. What we do is we just cash you out of that original private lending investment, and then we would help you acquire the turnkey rental property. We wouldn't charge you any fees for the early withdrawal, assuming that it came in the form of then purchasing a turnkey rental property with JWB. So it's really simple and easy. You don't have to worry about timing it perfectly. You can get started, and then when that next cash infusion comes, even if it's before the first loan is technically termed out, that wouldn't prevent you from buying your first rental property.
Got it. Makes a lot of sense, man. All right. I'm gonna keep going with questions that we had left over from Tuesday. Pat Staub, who was on the call and had a bunch of great questions, asked something that seems to be on the top of people's minds. Do you see rental properties market prices lowering significantly in the next 60 days?
And I want to say hello to Pat. I heard that Pat jumped on the phone with one of the mics here on my team recently. So hopefully Pat got that answer there. But it's a really great question. So I'm glad we can kind of share it with the group here. So, and we talked a lot about this, Pablo. I mean, this was the topic of our show when coronavirus hit, right? This was such a prevalent question in the minds. I mean, And there were so many questions going on in every facet of life. But one of those was investors who were thinking about buying their turnkey rental property. Should I be concerned about the market crashing, right? How do I make the best decision? And so we really coached and guided folks in a couple of different facets. First of all, I lived through the Great Recession. And if you could have painted a picture of what not to do as a young kid, struggling entrepreneur, just getting their feet wet in their line of business in real estate, of what not to do, that was me and my business partners in 2006, right? We understood how to raise money. We understood how to get financing. We understood how to buy properties. And so in 2006, at the height of the market, we went out and bought 40 rental properties. And we had financing, sometimes financing with high interest rates on all of those properties at that point in time. And then the market dropped 35% from 2007 to 2011, right? So if you could paint a picture of what not to do, that's what we did. Well, how that relates to the decision that we all have right now is that one of the beautiful things about owning rental properties for the long haul is that it doesn't matter what happens in short-term pricing, right? You are not the type of investor who has to check the stock ticker, has to check your appraised value every day, every month, every year. Because in rental properties, you're investing for cash flow, number one. And so while I shared with you that my market values dropped 35% from 2007 to 2011, my cash flow did not. My cash flow was consistent, right? And that's all that mattered to me at that point because I was investing for the long haul. So I was still earning positive cash flow on those properties. That allowed me to hold on to those properties, whereas other investors who were purely speculative lost them to the bank or had other issues, had to sell them. I never had to sell them. I still own them along with a whole bunch of others. And that solid methodology of investing in cash flow first is what saved my financial, future. I mean, it was not looking good, right, in 2006 when I bought those. But because I invested in positive cash flow, that whole pricing drop didn't affect me, right? So as it relates to what's going on now, positive cash flow is the first most important thing. Pricing in the short run doesn't really matter. What really matters is if you're planning on holding on to this for the long haul, property appreciation rates are actually consistent. It's not speculative if you're investing for a full market cycle. So whatever we're working through here with coronavirus, I think we can all agree it's short-term and temporary, right? Much more shorter term and temporary than what we dealt with in the Great Recession. And it's short-term and temporary. So I don't really get concerned. It doesn't affect my decision as far as how to invest in turnkey rental properties, assuming you're planning on holding on for a market cycle. Because market cycles, when you invest for a market cycle, appreciation rates tend to repeat themselves. And to put some data behind this, Pat, if you looked at the pricing from 2001 all the way to 2020 in Jacksonville, right, in the middle there, 2007 to 2011, it went like this, right? It went down 35%. But if you looked over a 20-year span, just about a 20-year span there, you would see that the average home price appreciation rate for that market cycle right there is just at 4% per year on average, which is just showing what we know is that over market cycles, no matter what happens in the short run, pricing tends to repeat itself for an MSA or a region. Jacksonville would be the MSA. So short-term pricing doesn't matter. But we should probably talk about where do we see pricing going, right? I mean, that's the overall theory behind it, but I would assume we should probably start talking about pricing. What do you think I'm going to talk about first when I go to like what's actually happening for pricing here? What's the best leading indicator, Pablo?
Gregg, I thought you were dedicated to asking me tough questions, man. You're obviously going to talk about months of inventory right now, right?
You have come so far. Not only are you getting the answers right, you're talking trash now
Yeah.
too, man. I like it. I like it. Months of inventory, man. I hope everybody in our group, in our audience, speaks months of inventory, right? This is the best leading indicator for you to understand where pricing is going in Jacksonville or in your local market. And it is not hard to get this information. What months of inventory tracks is the amount of homes that are in inventory. So on your local MLS, you can see how many homes are on the market, and you look to see how many homes sold the previous month. What it tracks is how long it would take to exhaust the current inventory in your market. And history teaches you that an equilibrium market is between 6 to 7 months of inventory. And an equilibrium market would drive that historically accurate home price appreciation rate of 4.3% in Jacksonville. You can figure it out for your local market as well. So when we're talking about what's going to happen with pricing in the short run, and to answer Pat's question directly, no, I don't see pricing dropping for rental properties, or really properties in the middle income to below middle income price ranges, because overall in Jacksonville, our months of inventory is 3.5. It's been in the 2s and 3s for the last few years, and it's been below 6 since 2014, since JWB started to track this. And so what this means is that we have a long runway of sales decreasing before it should start to negatively affect prices, right? I ran the numbers and I said, if sales were cut in half from what the sales were last month, what would our months of inventory be? And it would be 7 months of inventory. If you cut the number of sales in half, right? This is talking about in May, right? We've already felt the effects of coronavirus, right? It's not like a brand new thing for us anymore. You would still have to cut the sales in half in order just to get to 7 months of inventory. And 7 months of inventory doesn't mean that you're going to see price declines, right? That's just about equilibrium. So to answer your question directly, no, I don't see prices coming down. This is what we shared when coronavirus broke back in March. We shared the same methodology. It has played out exactly the way that we saw it would be. And if you combine both of these theories that we've just talked about here, and you look at the opportunity cost, if you're purely thinking about investing and you're saying, well, I'm scared about prices declining, you know, you are earning positive cash flow. Thousands of dollars of positive cash flow would be earned if you invest versus what you would give up if prices declined, let's say over a 6-month period, right? Not only are you like taking that chance that your property value may not go down, right? Property value may actually go up, which is what's been happening, right? But you would also be giving up thousands of dollars of real positive cash flow and tax savings and principal pay down, you know? So this is just exactly the way that we sort of thought it would be, even though none of us had really been through coronavirus times. It just shows you that the metrics that you rely on to make educated decisions don't change. And overall, even if prices did decline, I've been through that and came through on the other side and tell you that prices are still going to bounce back and appreciate on average about 4% a year, assuming you're investing for a full market cycle.
And there's also the opportunity that you talked about at length on Tuesday with Rich, of the fact that interest rates are historically low. Therefore, your cash right now, your cash flow right now is historically high on these properties that you do in Jacksonville, where the cash flow is just a small part of it, but it adds to the nugget, right?
Absolutely. I mean, I thought that was really insightful. You know, Rich, one thing you know with Rich is you are always getting the truth, you know,
Yeah.
As we all learned on Tuesday, right?
Yeah.
Rich is incredible. But one of the things he shared is, you know, Rich has been one of my great friends for years. And I know for you too, Pablo, right? Rich has been watching JWB for years. And sometimes people say, oh, you know what? Prices today are higher than they were in 2011 or 2012. Maybe I missed the boat. You know, maybe this isn't the right time to be buying turnkey rental properties, right? That fear that you can't get the same price that you did at the bottom of the Great Recession, right? Well, there's a lot of things that are different today versus the Great Recession, right? And one of the things is interest rates. So Rich looks at this and he's like, listen, I fully understand that prices today are higher than they were at the end of the Great Recession. That's just the reality. But I'm going to look at everything else. And one of the things that's much more impactful over the long haul is your interest rate. And you can borrow money. You can get conventional financing for interest rates in the 3% right now, that you're going to be able to have that loan in place for the next 30 years. I hope people understand what an opportunity it is to be able to borrow money at 3.5 or 4% interest for 30 years. Like, as an investor, we should be salivating because we all feel really confident that we can use other people's money and probably generate better than a 4% return on investment. So that's what Rich is looking at. And that's why now his plan, although he's been a private lender for a long period of time, his plan is to be purchasing 8 rental properties in his portfolio. And that's going to help him get to $100,000 of passive income by the time he's 55, because he's going to have those 8 properties paid off. So there you go. It's not just about price points. It's about all of those profit centers, and interest rates are incredibly low and a huge opportunity for investors right now.
Awesome. You know, we are 20. Where does the time go, Gregg? We're already 24 minutes into this thing. Got a bunch of questions to go. I feel obliged to say, for first time people that are joining us for the first time, if you want to know what JWB is about, go to jwbwebclass.com. And that is a solid 45-minute presentation by yours truly, Gregg Cohen, talking about the fundamentals of rental income properties, what markets are best, what to look for, and what JWB does different than everybody else. And if you have a specific question, if you are looking to acquire a rental property, which, by the way, we have somebody with us today, Amol Kulkarni. Amol, I hope I pronounced that correctly. Amol Kulkarni, who's asking, hi, I'm looking to invest in Jax on a rental property. Does JWB have any new single family homes / multifamily homes in Jax? Appreciate it. Thanks. Absolutely, Amol. And for you, you should, oh, and I pronounced it correctly. Crush. All right. So yeah, Amol, the best route for you is go to chatwithjwb.com. There's plenty of properties. Gregg, is there another one? Is the website also has some sample properties, or is Amol's best time used just directly booking a call?
Yeah, I would say both of those. Go to chatwithjwb.com, schedule a time with my team. We'll walk you through it. The answer to your question is, do we have those types of properties? Yes, we have new construction properties that hit these types of cash flows and returns. And then as a part of that, we're going to make sure that we send out the 3 property evaluations that you can look at real numbers. And then for those who are not ready to schedule a call yet, all of you can access those 3 property evaluations. You can do that by going to our site, which is jwbrealestatecapital.com. And there you just click on the link that says view properties, and everybody can get familiar with the numbers that way. And then you'll have the opportunity to jump on a call with our clients, with our sales team as well.
All right, cool. So we're going to get into some questions. We got a bunch coming in. Vinay Rogers asks, what kind of appreciated value on a property do you look for before using equity for purchase of additional properties? Is there a formula that you use?
Trying to understand that question. What type of appreciation do we look for before? Could you repeat that one for me?
Sure. What kind of appreciated value on a property do you look for before using equity for purchase of additional properties? Is there a formula you use? That's from Vinay Rogers.
All right. So Vinay's asking, probably has some equity in their previous purchases and looking to tap into that equity to invest again. They're asking, what percentage of equity should you get in order to then, roll that into the next property purchase? Is there like a threshold? There's not a threshold. I really think it's an individual decision for every single person. A couple of thoughts that I would have just to share with you here, and I really think you should be speaking with my team specifically about it. But many people think about equity, and it's nice to have equity, right? Equity is the amount that you've gained on the property, right? Either through property appreciation or principal pay down, right? Equity can be an asset for you that you just don't tap into, which, a lot of people don't, right? But it can be an asset that can really help further your goals. To kind of steal a line from my good friend Keith Weinhold, who runs a really successful real estate investing podcast, the return on equity is 0. The return on equity is 0. If it's just sitting there and you've got a whole bunch of equity there and you're not doing anything with it, that is an unused resource for you, right? And there are ways to tap into that equity, and you don't have to sell the property all the time to tap into that equity, but there's ways to tap into that equity that can further your passive income goals. And when I say that, I don't mean go crazy and go tap into your equity and to do, to buy things that depreciate in value, like cars and TVs, right? But if you're looking at that equity there and you're saying, hey, I want to get to this passive income goal of $100,000 like Rich does by the age of 55, what could that equity do to serve as a down payment for me for my next rental property, for my next 3 rental properties? And that's absolutely something that you can be leveraging to help you get there. So no right answer or wrong answer. What you'll typically see is that if you're looking to tap into the equity, plan on, if it's a primary residence, your home equity line of credit won't allow you to borrow more than maybe 90% of the value of your home. So if you only have a 10% equity spread in your property, you're probably not going to be able to leverage a whole bunch of equity. Even if you go and you sell that property, if you have a 10% equity spread there, you're going to get eaten up, and you're selling, holding, and closing costs there as well. So I would say start to look at it if you have more than 10% of equity. And obviously, the more equity you have, there are always some costs in leveraging that equity. So the more equity you have, the better decision it is to start to tap into that.
Great answer. Mike Foster has a question. I know loans to JWB are 3-year commitments, but what is the average amount of actual time JWB loans last before principal is returned? Do you have a benchmark? I know that you don't like to promise anything under, but is there an average?
And Mike's been a lender of ours for so long, so I was going to ask him to help me out with it too. Mike, if you could kind of share some of your loan paybacks to us over the years. Mike, I know you were lending with, I don't know if you're still lending to us, actually. Let me know if you're still lending to us. And if you have any of your paybacks, share it with us. But generally speaking, like most things we do at JWB, we're going to try to under promise and over deliver. And we know that loan paybacks are a really sensitive thing. You don't want to be late on a loan payback, right? So we do build in a buffer there. For us, it takes maybe, call it 9 months from the time that we start to acquire a home to when we build the home to when it's ready to sell. We typically, once the home hits the market, we sell it in a week or two. And then it takes, a couple of months for the financing to go through for that end buyer. So you're looking at typically about a year, let's say, for a normal property to go through the mix and then be sold on the back end. So, that would be kind of everything goes according to plan. A year is when, and that's very normal for people to get paid back, and call it that year to 18-month time frame. You have to be comfortable for 3 years. Don't be surprised, and don't hold me to this, that you want to get paid back in a year every single time. But just to kind of answer Mike's question, if it's, we call it a year to 18 months is pretty normal. Not every loan that we do will be a turnkey property loan, though, as well, right? There will be certain other loans that will be different. They will have a different exit strategy, and they may have longer timelines as well. So, but the turnkey rental properties are the majority of what we do and what we build. And so hopefully that kind of gives you a little bit of a heads up there.
Gotcha. Great. So for context, when I did private lending, it was right where you said. It was about a year, between a year and a quarter and a year and a half. I remember getting paid back. So right along with what you're saying. So right now is when I'm going to bring up our Facebook group, which you can go to by going to jwbfacebookgroup.com, and you can join in. And the reason why I am bringing it up is because we have a great community in there. And one of them is George Malachi Varner, who has our next question. He's a super talented cameraographer, drone operator, photographer here in Jacksonville that made a really cool video of the mural that JWB put together at College Park. And his question is, which you can see inside our Facebook group, his question is, after you read Rich Dad, Poor Dad, what did you do next? As in, what was your actual plan of action after you hit that switch?
What was my plan of action? Well, I knew that I needed to learn from those who had done it before and who were much better at it than I was. And so it was Alex and myself at that point, my business partner, Alex, and myself. And so we immediately started to go and network, and we started to read more books, and we started to really try to find mentors. That was our goal. And so we went, there's a local Real Estate Investors Association here in Jacksonville that we went to. We went every single meeting, and we went before the meeting, and we networked as much as we could and just asked questions and tried to learn who the movers and shakers were. And we stayed late afterwards, and we tried to take people to lunch and try to figure out what books they were reading, and that led us to what conferences they were going to. And all of this was really, free or very inexpensive in the beginning. And, at the same time, we went out and we tried stuff. When we talk about buying houses, if there's a strategy to buy a house, I've done it. And, that involved going out, literally driving around and finding houses that looked like they were in disrepair, and then just knocking on doors and asking people if I could buy their house, or asking neighbors and sending letters and putting out signs. And so, those were really the things that we did in lockstep. And so that constant learning and networking and trying to understand in a very humble approach of like how to do this the right way, and then getting out there and just falling flat on your face over and over again was a really, important kind of carousel for us. And then ultimately we found mentors that we really could just kind of latch onto in a sense. Really, they just kind of were a concrete vision of who we wanted to be as a real estate investment company. And many of you are familiar with Fortune Builders. And we got to know them really by chance at a conference. And they became really kind of our main mentors as we started out in our business, and now have turned into, partners. They refer a lot of their business to us. And that's been a beautiful relationship now for almost 15 years now. But yeah, I'd say that constant kind of learning and that constant doing and just kind of iterating that way is really the first thing that we did.
Great. Vinay has, oh, by the way, we have an episode with the founder of Fortune Builders, Stan Merrill, that is on our YouTube channel. You can see it on our Facebook group as well. Soon to come on our podcast, which I highly recommend. Today passed, by the way, 250 downloads. So
no way, dude.
We're
Congratulations,
booming,
man.
Yeah. No, congratulations
that's
to
Pablo's
you,
baby,
co-host.
man. That's Pablo's baby. If any of you haven't listened to the podcast, you should go ahead and do that. You can go to, where can I go? NotYourAverageInvestorShow.com.
NotYourAverageInvestorShow.com. Any of the, wherever you listen to podcasts, if you put in Not Your Average Investor Show, it'll come up. Yeah. And you see our mugs right there in the thumbnail. So yeah, it's should be a good experience.
I've never looked so good as when I'm next to you, brother.
I think that means,
is that a compliment?
Yeah,
that was supposed to be a compliment. I think that was a backhanded compliment. I didn't mean that.
Knowing you, I knew it was well intended. Listen, Gregg, speaking of well-intended things, Vinay Rogers has a question that I think is more of a request that I want to ask right now. He's asking, does anybody have a spreadsheet that they would like to share on how buying and holding properties with accelerated payments and how that looks over the years, that we can share with them? And what I would like to say is, I think we should do an educational episode of going through a spreadsheet that breaks down those numbers. You up for something like that?
Let's do it, man. I like it.
Yeah. So Vinay, we don't have that spreadsheet handy right now, but I promise you in the next 2 to 4 weeks, we will do an episode dedicated specifically to walking you through that.
And, the other thing I would talk about, Vinay, our property evaluations build in your principal pay down. So it won't be exactly what you want, but if you want a head start, you can look at those property evaluations that we have available on our site, and you'll start to see how the amortization works in your favor, meaning every year more of your principal is paid down. So that's a head start. And if you're looking to kind of take it to the next level, which is, how do you purposefully add more cash flows to the pay down? That's something Pablo and I can certainly do in the future.
Yeah. And just FYI, Lee in the chat says he can get you that. So he's got one that'd be happy to share if you guys want to connect inside the Facebook group or outside, or Lee, you can email me and I'll email it to Vinay, however you want to do it. Right. Okay. So Eddie Harris has a clarification here. For hard lending with JWB, is it 10% on points, or does that number vary? Thanks.
Great question. It is 10%, no points. It is a flat 10% interest rate is what you'd be earning for private lending with JWB.
Great. I'm going to pepper in one here from the chat. Steve Mitrano is asking, Does JWB only provide single family turnkey or multifamily as well? I know you love answering this.
It's a great question. We love both single family and multifamily as investors, but the problem with multifamilies is that you're just not going to see a lot of housing stock here in Jacksonville in the neighborhoods that you want to be owning rental properties. It's just not the way the housing stock was built here in Jacksonville. You go to the Northeast, you'll see a lot of multifamily properties and great cash flowing neighborhoods for you, but it's just not that way here. So you're not going to see multifamilies at JWB. But what I will tell you though is, and I always joke, we get a lot of questions about, do we have multifamilies for sale? We never get the question, do you have townhomes for sale? And townhomes many times are a better investment than multifamilies. And so JWB does have townhomes that are for sale. A townhome is really just maybe a 4-unit or a 6-unit building, just like a multifamily may be, right? It has one roof. And the only difference is how it's owned. So let's say it's a 4-unit multifamily property. It's called a quad, right? One roof over 4 units, and that's owned by one investor. You can have a 4-unit townhome, which is the same thing under one roof, and it's owned individually by maybe 4 different investors, or maybe one investor owns each of them individually. And the advantage there is that, number one, you can be in the right neighborhoods in Jacksonville to do that. And number two, it creates an incredible amount of flexibility for you as an investor, right? Down the road, if you want to sell one of those assets, or if you want to refinance one of those assets, you can do that with townhomes. With multifamilies, you cannot. So a lot of advantages there. The one disadvantage I would say for a townhome versus a multifamily is that flexibility of you having 4 assets that you can either get loans on or sell or refinance, those count as 4 individual loans on your credit. And your best financing gets to the point where you have 10 financed properties. After that, your financing terms become a little bit less advantageous for you. So a 4-unit townhome would take up 4 spots for you, get you great flexibility, but it would take up 4 of those loans. A multifamily property would only take up 1 of those loans. So there's the positives and the negatives. But we do have townhomes, single family homes, of course, not multifamilies at JWB.
Great answer, Greg. And you actually knocked off a question by Jim Kirko that was also asking about whether you can group the mortgages into one multifamily if it's a group of townhomes or not. It's individual mortgages then, right?
Individual mortgages for the townhomes, yes.
Excellent. Okay. Lonnie Thompson asked real quick, I'm just going to answer it. What is the minimum investment for hard lending? It's $10K, Lonnie. It's $10,000 is the minimum investment. And now we're going to go to more nuanced questions. Mike Foster asks, on JWB turnkey rental properties, what property care tasks are done by the JWB property management team versus the property care tasks that are the responsibility of the renter? And are renters offered any financial rewards for doing some of the JWB labor themselves?
I'll answer the last part of that first. No, there's not incentives given to the residents to do some of the work that maybe JWB would be responsible for. At the end of the day, that would decrease your returns. But more often than that, if there's certain work that you don't want to let a resident do, right? They may not be qualified. It may, hurt your investment in the long run. So you want to make sure that somebody like a JWB would be handling that. So that would be 2 of those reasons would be why we don't incentivize that. What is required, of the resident. I'll just go with some of the simple things, right? Normal maintenance of the home, of course, is required by the resident. Landscaping is required by the resident. Utilities must be in the resident's name. Those types of things. Any of the major mechanicals in the home would be, the owner's responsibility, and by way of that, JWB would be handling those repairs or any maintenance items or any issues there. Really anything, any big expense that is kind of, related to the structure of the home or the long-term well-being of the home, that's going to be the owner's maintenance, and that would be what JWB would take care of for you. So, and if you have specific questions, Mike, go ahead, let me know or let Pablo know, and I'll have my team get back to you on it. It's a great thing. What Pablo asks everybody to do is to put the questions in the question box. Because when you do that, that way we have an easy way to follow up with you afterwards and send you an email or offer to get on the phone with you and answer those specific questions. So if you have more specifics, we'll be happy to do that for you, Mike.
All right. Vinay Rogers has a couple questions, but I'm going to group one with a question that Marilyn asked. First one, do any lenders have a COVID plan, and how does that in affecting, I'm trying to read this in a way that's easier for you, Gregg. I think he's asking for, Vinay is asking for a COVID plan on getting renters to pay their rent payments. And Marilyn Cotterman had also asked, what are the rent collection numbers for May and June so far? I'm sure they're great is what she said, but I'll let you answer that.
Yeah, it's funny. We talked about rent collection numbers, I think, all day, every day on every session during March and April and May, and we haven't talked about it as much now. It's really back to business as usual, and thankfully, business as usual is great to be at JWB. You know, historically, we collect 98.5% of rents. When all of this broke, I didn't know how it was going to land, so I prepared people to expect a short-term temporary loss of rental income, but then I was wrong. Our property management team has just done a fantastic job in collecting rent. In the month of April, we collected over 97.5% of rent, and that's during a time when you cannot evict, right? We are still during a time when you cannot evict. So you'd imagine as a property management company, when there's not a consequence for not paying rent, it would make your job more difficult. But as I mentioned, over 97.5% of rent. At the end of May, we are over 97% again. I think the number is 97.13% if I remember what I was looking at before. And we still have a few days here to get that number right up to 97.5%, which is where I would expect it to be. So, 97.5% is kind of this normal during this time, as I'm mentioning, when you cannot evict, and during a time when there's incredible uncertainty for a lot of people out there. So rent collection is very, very strong.
Awesome. And Vinay, I want to encourage you, because it sounds like your questions are geared towards other investors and other lenders kind of sharing practices. I would love to encourage you to get into our Facebook group, right? Go to jwbfacebookgroup.com, because that's a really good question. You know, those types of shared resources is why we created that Facebook group. We got over 1,400 people in there. And I think that would be a really, really good resource for you if that's what you're looking for. So Vinay's asking, and this is last question I'm going to ask here so that we can get you going to your next meeting here, Gregg. But we love having too many questions. This is great. Yeah. Keep them coming.
What a luxury.
This is awesome. Vinay asks about a COVID plan for buyers, and he's been ready to pull the trigger on a few more rentals, but COVID hacked his job, and now he's having a hard time with lending. Any suggestions on finding lending for rental income properties right now in this climate?
Yeah, it's great that, you kind of see not just, that what COVID has brought to us is really temporary in nature, right? The fundamentals of investing are strong. That's why people are investing in turnkey rental properties. I'm sorry that had some, maybe some job situations or things that have kind of prevented on the lending front, but that's really temporary in nature. So, it is going to be a little bit of a challenge. I don't know the specific situation that you have with the job and whatnot. If there's not that documented income, it's going to be a challenge for you to get a loan. What I would say is, there's a lot of sources of capital out there that you can look at that, you may already have access to, but you might not have been looking. Like, for example, one of them is your retirement accounts. People are shocked. They don't understand that you can actually buy rental properties in your retirement accounts. That might be a great way to do it. Some other strategies that I've done personally, especially when I was starting out and I didn't have any money, was I partnered. I found ways to partner with friends and family members to where I could bring the credit and they could bring the capital, or vice versa. You could bring the capital, they may bring the credit, as a way to sort of partner on these deals. But the good thing is that when that job situation does resolve itself, lending, is going to be there, and interest rates are so low that you could put a strategy together now to get started, right? Maybe partnering is the right approach for you. I would really recommend talking with my team before moving forward on this, but maybe that's the right approach. And then, you could refinance in, maybe 6 months or a year and take advantage of these really low interest rates. So, those are some options out there, but yeah, at the end of the day, if you don't have a job, it's going to be hard to get lending at rates where you're going to be able to get positive cash flow, right? What I would not recommend you do is go out there, get hard money, pay really high interest rates just to get into a rental property, because you won't be accomplishing goal number one, which is positive cash flow.
All right. And that is all for today, Gregg. We have one last question here from Ben Just. He's saying that you can buy a single family home with 40 grand. He left his contact information here. Ben, we will follow up with you for sure. If you want to jump out ahead of it, go to chat with JWB, set up an appointment, or we can contact you and set up an appointment that way, right? Am I speaking correctly there, Gregg?
You know it, brother. Sounds great.
Okay. Super, super. And I just want to say it is an absolute pleasure to have 34 people join us on a Thursday, middle of the day. We do not take it for granted. The questions that are, I had a list of like 6 questions. We got to one of them, and I couldn't be happier about it, because we much rather speak to people, speak to you directly, answer your questions on these calls. That's what these things are here for. I would love it if people would join the Facebook group as well, and just interact with us throughout the week. Gregg goes live in there every morning with his real estate walk and talk tips on everything. And last but not least, if you want the fundamentals of it all, jwbwebclass.com. If you want to book a call, go to chatwithjwb.com. Super informative, value-driven call. You'll really enjoy it. And I want to say thank you from me, and I'll leave the last word up to Gregg today.
Thank you to you. I mean, you stole the words right out of my mouth, Pablo. I truly enjoy being here with you, Pablo. I enjoy being here. It's funny, we're all virtual now, but the sense of community that we have here, and it's even different on Thursdays as it is on Tuesdays, right? It's like Tuesdays, we love Tuesdays. There's a little bit more of kind of an agenda that we'll get to, right? When many times we have a guest on and we want to make sure we highlight there. Thursdays just feels like we're just hanging out with our buddies. And I appreciate all of you guys and the engagement that you guys bring here. So we'll keep doing it as long as you guys are having value with it. And so that means we'll be here every Tuesday and every Thursday at 12:30. Looking forward to the next one.
All right. See you all on Tuesday. Have a great week, everybody.
See you guys.